there, it's Phil Ratcliffe with Rebel Financial, and thanks for tuning in today to another one of our broadcasts. Today, we are going to talk about something that is blowing up the headlines when you're looking at everything that's going on in the markets, from Bitcoin to Ethereum and other cryptos, GameStop, and just asset bubbles in general, to talk about it in a timely fashion when people are really kind of paying attention. So again, thanks for joining in. Think you will enjoy this. It's going to be a much different viewpoint than you'll probably hear on a lot of the other financial networks or newspapers or from journalists, etc. Because, of course, we are fiduciary investment advisors and financial planners. So number one, when we tell people things, we have to be very careful, because as a licensed advisor, what we say can be construed as investment advice. So number one, I'm going to say this at the beginning, and I'm going to say it again at the end. This is not individual investment advice. Every person is different, and you really need to talk to an advisor that can look at your personal situation, and a lot of times in collaboration with a tax professional, whether it's a EA, CPA, or tax attorney, and sometimes even an estate planning attorney. So again, we're going to talk about things, but you need to consult your individual advisor. So, kind of moving forward, when we look at things, the markets are going crazy, right? We had pandemic and recession. We're still not done with the pandemic. We have a minority of people vaccinated, but the markets have just really taken off. Really, probably as a two-pronged consequence of stimulus, right? So governments around the world, especially ours, injected a ton of capital into there. And of course, they're anticipating the Biden administration and Congress doing more. And then secondly, we go through these periods of boom and bust, right? It's really fear and greed. And right now we are seeing the teeth of greed hugely, whether it's people trying to wrap themselves in a Robin Hood cloak, like they're trying to take down hedge fund managers or whatever the case. It's really greed from the vast majority of them. Even some of the people that act like they're good, I've seen their posts online talking about how much money they made, etc. So, and of course, when we look at what's happened with cryptocurrency before, the latest incidents of all the GameStop, AMC, BlackBerry, etc. So when we really look at this, there is a robust history of these things happening. When we really look at, asset bubbles through history, you can just Google this, Investopedia, Wikipedia. There's lots of financial companies, fund managers, etc., that have written tons about this, and of course historians and whole books on the individual subjects and what happened. So, of course, I think this is probably one of the earliest, the tulip bubble, which a lot of people have heard of. I'm sure there were lots of bubbles before this, just not documented well. Heck, I bet you could go back to Sumeria and whatso, and I'm sure they had some kind of bubble on early honey wine or something like that. Who knows, right? But it's almost intrinsic, I think, when you get civilization or large groups of people together that are trading, etc., that you are going to have market inefficiencies. And interestingly enough, one of the things that's happened over time is that markets have supposedly gotten a lot more efficient, and absolutely they have. But things like this aberration with what's going on, like say with the GameStop, that's market inefficiency, pretty hardcore. So anyways, there are some paradigms. We're still human beings, right? We're not computers or machines that are just going to do the most rational thing. And you can see some of the big ones kind of throughout history. Of course, most of us know the dot-com bubble and the housing bubble that we are familiar with, lived through, or at least are old enough to have heard about and know people that were hit by the dot-com bubble. So, but that is just a really small list. Look at all these. Whoa, there's a ton, right? Look at them all. You can read through them, read histories. This is not something new, and it's something that's going to continue to happen as long as humans' irrational selves are in charge of their capital in a free, as it can be, market economy. And so you can kind of see the last one that they have listed here, was 2021 social media crash. They really won't list the bubbles that may be occurring now, because we don't know necessarily that they're a bubble or not until Bitcoin or Ethereum crashes, or until this mini bubble of almost what we say earlier, Robin Hoodish, like going after the big financial companies with AMC and BlackBerry, and when it collapses, then it will be called a bubble once it proves itself. So, and then maybe the market rally in general through the pandemic, maybe those aren't in line with what the value of these investments should be, and then they will be added on to this list of bubbles that we have lived through. So this is not anything new. So I mean, that's kind of one of the things I want to talk about, just so people understand. And it is tough to identify some things, because I think there is a tendency for people to think that they live in a unique time of history, and of course you do. I mean, history doesn't necessarily repeat itself. We tend to go through very similar series of events that are obviously very different in terms of what they're made up of, but as a system over longer time periods, they do tend to have a cyclical nature, just kind of like having an economic boom and then a recession, right? Tends to happen. But the things that caused it are obviously different. The people that were alive back in the stock market crash in 1929 and what they believed in and how they grew up is very different than how you grew up and had our big recession of 2008, 2009, right? And so it's very different, but there are a lot of things in the general system that are very similar as well too. So we can learn from these things. So, kind of moving on, just understanding these asset bubbles, it really has to do a lot with a disconnect between the reality of what things cost or are worth versus what people will pay for them. And this is a criticism in general of uh, of the financial system in general, is that a lot people will argue, oh, everything's made up. What is a dollar anyways? It's a piece of paper, right? And then what's the value of a chicken or of Bitcoin? It's something that we collectively agree to. It's an idea, right? And so these ideas don't necessarily have to be grounded in reality to where there's lots of other facts or things backing them up, right? And so when things take off or meteorically crash back to the ground, sometimes those are very far extreme from what you could ground them in, like fact and what so. And so, of course, these asset bubbles, kind of go from that. There are different reasons for it. In this case, when we're looking at, Bitcoin, Ethereum, etc., um, and you could even think about Tesla as well too. I think that these actually have decent arguments that they're going up for a reason. They are going to be worth these things in the future. However, you tend to get to extremes in terms of, oh well, Bitcoin went from 4,000 to 20,000, so I'm going to jump on. I think it's going to go to 100,000. Well, maybe really it should only be at 20 to 30,000, somewhere in between there. But people are just going to keep pushing it as long as they can. And of course, what happens eventually, sucker that will jump on at where it peaks, maybe 40 or 50,000 before it crashes down. And of course, after it crashes down, lots of people are burnt by that. And of course, it forces more selling, et cetera. And it goes way down below what it should be. Eventually, things tend to get for the majority of time to a point where they're trading, fairly valued, and then just going above and below over time as people try to predict the future state of these things, right? So, but right now you are in a period to where people have made a lot of money from the bottom of the pandemic to now. Technology has enabled more people to participate in it. It has not stopped when it probably should have, and so people are just riding on it. And there's industry kind of saying that everybody looks like a genius when you go through these really bull markets to where you may have bubbles, because it's tough to pick something that's losing right now, right? And so, now that it's very easy to just, get on your phone and punch in some trades, a lot of times even borrow money, to do it. and jump on board, and you may have made money, buying GameStop when it was at 100 and went up to 400. That company realistically is probably only worth, somewhere between $12 to $20 a share. And so to make money on it going that high is just ludicrous. But it's a market economy. People can do what they want. I'm not against it per se. I'm just saying it's very dangerous because it is an aberration, right? And this is an inefficient market. People are paying for things crazy amounts what they're worth. And, I'm not going to get into the merits of either side. I'm not a big fan of the hedge fund companies or people that are almost maliciously shorters. So I'm not going to defend them either. But it's dangerous, very dangerous. Regular people should not be playing this day trader game. Almost no one should be trading this except to speculate, which means that you should anticipate that you are going to lose a decent to significant amount of your investment. If you come out ahead, good for you, but you're probably not much better off than going to the casino or, doing your sports betting or whatever you do. Let's be honest here. This is not investing. It's speculation. Okay, investing is investing for a long-term rate of returns from things that are high probability, kind of like what Warren Buffett does. Like find good companies, try to buy them at a good price, and then hold them for a long time. It's just like thinking about, hey, you can think about when you were a kid and you opened a lemonade stand, and you can make your lemonade for 2 cents a cup, and you sold it for 5 cents. Inflation now, maybe it's you can make it for 10 cents and sell it for 50 cents or something as a kid, and you make a profit, right? And over time, if you were to continue to do that and scale it up, you would make more and more and more. There's value, and then people are happy that they got some lemonade and helped the kid. It's a win-win type thing, right? There's a very big difference between the speculation, short-term profits, where it's a zero-sum game. Zero-sum meaning that for somebody to win and make money, somebody else has to lose money, and where all boats rise as we continue to make utility and progress as a civilization, and we benefit from owning those assets over time. So just to be clear on that. So, so we're talking about, I'm going to go over a little bit of crypto. That was what this one was supposed to be about. And of course, it's kind of muddied the water with everything that's going on now with, the GameStop, AMC, et cetera. But, there are hundreds of cryptocurrencies now. You got to be really careful if you want to invest in this. And the reason that I said that, hey, this area of blockchain technology, which Bitcoin started, and in my opinion, why Bitcoin is so important. I really am not a huge fan of like what Bitcoin's future is going to be as like something that has a lot of utility for humanity. I'm not even a fan of gold, so like when they try to call it digital gold, like to me that's it doesn't make it any better. But anyways, a lot of the Ethereum-based tokens, which a lot of these are, like actually have business purposes to like enable B2B like transactions, or AppCoin to allow people and advertisers to pay each other online in really small micropayments. And there's just a lot. I mean, you can look at smart contracts to where we're trying to automate processes that companies in the past, like title companies, et cetera, in like say a real estate transaction. I mean, the cost can go as high as 8%. I mean, 8% to sell a house, that's crazy town. And it's because we don't trust each other. And so if we could make technology be able to make some of these things almost a trustless transaction, like I don't think anybody nowadays balks at going on Amazon and buying something, right? Because if somebody rips you off, you're going to get your money back. Or if something's bad, Amazon's going to take it back. That no problem, right? There's no risk there. But before, I don't know if you can remember, when things were new, maybe 15 or 20 years ago, people like, you would put your credit card number like on the internet, right? And so these things could reduce that down, reduce all the costs, make like our lives way better, faster, more efficient, less fraud, et cetera. So to me, yes, a lot of these currency people think, oh, this is just like the dollar or the euro or what's. Yeah, some of them are, and that's how things kind of started as an online non-central government or entity type thing, and then building it to where we don't necessarily need some middleman entity in the middle. Awesome, right? But really what it's evolved to is to say, hey, we can use this technology to do a lot more. So when I say that, hey, we don't know what the future of this is, you can kind of think about Tesla. People are like, oh, it's way overvalued. And they keep saying that and it keeps going up. And you know what? Tesla keeps succeeding. I mean, I think there are very few people now that would argue against electric cars being the future. I mean, even GM announced that they're going to get rid of all their gas vehicles by 2039, like gone, like the entire lineup, right? And so they're there first, and they're still kicking everybody's butt. And if they come out to sell, even a fraction, 20 or 30, heck, maybe 50% as much as GM and Ford used to, then they're probably undervalued, right? So again, I'm not saying that's what's going to happen, but there is a case. There's a case for that. I don't think there's any case the GameStop's going to turn it around and like beat Microsoft and Xbox and PlayStation and take over the online video world. There's no way. I mean, I guess there's a way. It's just so low probability. That's the universe is based on statistics, not on 100% this way and 100% that way. So, anyways, that's kind of my spiel on looking at this. But I mean, you can even see more than likely in the shorter term, probably is a bubble. I mean, look at this. Earlier in the year, trading at 5 to 4,000 all the way up to 40,000. I mean, I talked to some asset managers and stuff. And it really is duality of people that really put a lot of time and money into research and are saying, yeah, Bitcoin's going to crash. I got some other people to say, no, Bitcoin is going to, hundreds of thousands of dollars per coin just because of supply and demand. And look at this curve versus how, when gold was younger and these other commodities, et cetera, that has a limited supply. And so who knows? Exactly where it's going to go. So you need to be careful with this. I mean, this is a highly, highly volatile young market. We don't know where it's going to go. It's very speculative. More than likely, though, are some of these Ethereum-based tokens going to have real use cases that could even be like a 1% valued versus what they're going to be in the future? Absolutely. I'm not saying that it will happen. I'm saying there's a decent probability for that. You just don't know which one they are, right? And the vast majority of them probably will fail. So you can see Ethereum is even more than Bitcoin. I mean, down at low 100, all the way up now to like $1,400 a coin. So I mean, that's fabulous. So, but I'm a much bigger fan of the Ethereum-based tokens than digital gold. Some people call it Litecoin, digital silver, but I do like Litecoin more than Bitcoin. But still, just cashless payment transactions. I mean, when you look at your PayPal and some of the other micropayment online things, they are blazingly fast, good. They've already got huge user bases. It's very cryptic to use some of these things. I mean, if you do this, I mean, I do it a decent amount. It's not that bad, but for someone else, this is like trying to get them to write an easy, but still trying to get them to write a computer program. They don't want to do that. They want to use Windows. They want to use Mac OS and for it to be all gooey. This is not that at all. So if you did want to get into it, there are lots of different ways you could do it. I personally use Gemini, Binance, and Exodus. And so these are, kind of hot online wallets and trading platforms, kind of like custodians like Schwab and TD Ameritrade, to where you can actually put orders in and buy and sell and move money from fiat, meaning your checking account or whatever, into there. Please don't invest on your credit card. That's ridiculous. Don't try to buy crypto or some stock from your credit card. That is irresponsible, no matter your financial situation. So anyways, looking at Gemini and Binance, you can hold stuff online. You need to be really careful. I mean, security with crypto, because if somebody gets your addresses or passwords, they can take your stuff and you will never, ever, ever get it back. If you lose your login and security backup stuff, you've read the articles and stuff about people losing, their whole savings or, millions and millions of dollars because they can't get back in. You got to be careful with this. And then, anything, whether you're, trading some of this stuff on Robinhood, or now that they got free trading everywhere with fractional shares, which we're our next one next week's going to talk about that. I kind of bumped it to next week just to talk about this. You really need to know what you're doing. You need to do some research. There's all kinds of stuff online where you can read about how to trade. And really, our recommendation is always to be a long-term investor. But in the short term, you're going to have to trade to get in and out, or rebalance, or get into the market, or reduce your risk sometimes when certain parts of your investments, if you're diversified, having your eggs in different baskets like you should, you're going to need to trade. And so make sure you know what you're doing. Don't just be put in market orders, which means just saying, I want to buy this. If you do that, that's where these big companies and hedge fund traders and predatory traders are just going to take you to the ringer. It's why trading is free, because they're basically front running. It's supposed to be illegal, but the SEC allows it because they say that it's taking down the cost of trading so low that it's better than this. I still think fundamentally that it's illegal and they shouldn't be allowed to do it. But basically what they do is, say you wanted to buy a stock and it was $5 and you just put in the market order, since they are faster than you. So say they have a direct connection to the custodians where it's clearing, they'll go buy it for like $4.96 and then sell it to you for $5. So it said $5, you bought $5, right? But they just made 4 cents on that. They're doing that to everybody all the time. That's how they're making all this money. Or part of it, not all of it, but part of it. To be able to give you free trading. And you got to be careful, because like when you do things that are going crazy like this, the spread could be enormous, especially like in cryptocurrency. I mean, you could have to where, Litecoin is at $140, but the spread is between like 200 to, like 90 throughout the day. And so if you're just the big dum-dum that puts a market order in to say, I want to buy this, it could shoot up to where somebody put a limit order in for 200 and you paid 200 when the spot price is really 150. Now that's a very extreme example, but these things happen. So you need to learn about limit orders and stop limit and how these things work, or you shouldn't be playing in the ocean. You're going to get eaten. So, that kind of brings me on to, and then, this is a wallet to where you can store things that are on your local computer. You can read all kinds of articles. I'm not going to get too in depth. This is probably already too long already, about how to safely keep your stuff. Instead of having it on a hot online thing, you just have it on a computer. Some people even go extreme and not even have the computer that they have this on really connected to the internet. Or a separate network from anything else that they do. So it really makes it low probability that somebody could steal if you're keeping a significant amount into there. But you can read about this if you're actually going to invest or keep it as a store of value or what so. So did want to go over it. Of course, there's all kinds of commission-free trading. I've kind of already hit this. Now, fractional shares. We're going to talk about all this next week in terms of like the good things that it's doing in the future of investing. But for now, it seems like they're trying to do the Robinhood thing and being good to everyone and trying to democratize things. And I think a lot of these technologies can be used for this, but the SEC is investigating Robinhood, right? And you know why? Because they're selling the order flows out there, and exchanges are making tons of money, and they're kicking back to these custodians based on your order flows, right? So to me, it'd be a lot more transparent if they could just reduce the cost for everybody, but we paid our own costs, and they actually executed your order to its best execution. That's kind of the industry term for that. And it doesn't really happen. They say they're doing best execution, but it's not. I mean, if you read that book by Michael Lewis, Flash Boys, and the starting of IEX, which was an exchange started to try to stop that, you can get a better understanding. It's a long read. But it's worthwhile. I mean, it is amazing to me that this has gone that far. And, I can understand if people understood this, which I don't think very many people do, why a lot of the traders like on Reddit and WhatsApp are mad at the big guys, because they are kind of gaming the system. And you know what? The government's letting them do it. And so, but that doesn't excuse the fact that a lot of the people on that board, if they told a bunch and solicited a bunch of people to buy stocks that they already owned before they posted that stuff, that is market manipulation. Those people are, well, based on the law, should be charged with market manipulation, which can hold jail time, disgorgement of profits, and punitive fines. So I could see that very much happening. It probably should happen because there needs to be trust in the markets, but it would be very unfair to go after those people and not go after, a bunch of the exchanges, maybe even the custodians, big quants and hedge funds and stuff that have been front running and doing other illegal things that the government's been letting them do. So to me, they need to just, the system is built on fairness. We need to trust it. Otherwise, we're going to think that it's rigged and we won't want to participate, right? And that fairness is what makes it work so that we can agree on, what is an acceptable price for things, even if there are shorter term aberrations. So again, I will stop preaching. But you can kind of see over time, there's bulls and bears. There are run-ups and recessions, and it's going to happen over and over and over again. You want to invest for the long term because how you create wealth that actually is going to stay for you, that you have a high probability of keeping and not losing, is to invest wisely over the long term, to buy low, to sell high, to have your eggs in different baskets, to save appropriately for what your goals are. Let the compounding power of money work for you. Make the right tax moves, to legally give the government as little as possible and get as much tax deferred growth as you can. And there are lots of other things that you can do. Again, that's my whole profession. What we do as investment advisors and financial planners is to help people do that. Market timing doesn't work. There are obviously always exceptions to any kind of rule, that are the tails of a normal distribution. So when we look statistically, people that market time or day traders or what so, on a risk adjusted basis, tend to do somewhere between 1% to 2% per year, behind the markets. Retail investors, in general, the last almost 50 years have done 3 to 4% per year behind the markets. And so just getting the market rate of return, if you can do it over a long period of time, is a really good rate of return. Right now, I know that pales in compared to how much people have made in the short term from some of these rallies from the bottom of the pandemic, and from cryptocurrency and investing in Tesla and some of the tech companies. But mark my words, if you do it long enough, it only takes one failure, of one thing that you put too much in to wipe out multiple times, years, sometimes even a couple decades of winning that short-term stuff. It is gambling, and eventually, statistically, you lose. Okay, and you would have done better off actually investing for the long term, even though it sounds really super duper boring. But you can Google this and find stuff for yourself. I just pulled up a couple things that just talks about market timing. So you can pull up research on market timing or day trading, and you can find all kinds of research. Now, again, know what you're looking at. Make sure it's footnoted and researched and from legitimate sources. I think the election and all the polarization that we've seen, kind of teaches everybody that confirmation bias abounds, and it's very difficult sometimes to sort out what's real from what's not real. Because it seems like everybody has their agenda, right? So anyways, when we look at human beings for these things, we're not made to do this well generally. You got your fear of missing out, which is the one you hear on the radio and the shows and articles and everything right now, which is, people wanting to get into the crypto or into Tesla or into this. And a lot of times by the time that happens, it's too late. You got loss aversion on the opposite side of things. It's generally human beings, the pain of losing something hurts them more than the gain of when you win. And so over time, it tends to handicap people. Recency bias. We tend to think about things that happened, more recent as having a lot more weight than things that happened in the past. That's an easy one. Like right now, things that everybody can win. People forget about 2008, 2009. That was back then, right? And there are lots of other examples of that. Attribution error is probably one of the largest ones that I see that hurts people on multiple levels, not just investing, but basically that's And it's probably a good defense. All these things evolved in us because they helped us survive. They just don't do very well in the modern world, especially with money and investing in it. So, but attribution error is kind of that tendency of, when something bad happens to you, you tend to blame the environment or someone else. It's not your fault. It's just like, it was a recession, or they are laying everybody off. It was just a bad time. When good things happen, like, man, I made 1,000% off of investing in, this solar energy thing, and then I got into this marijuana stock, and then I flipped over into AMC, and I made all this. It's because I'm awesome. It's not because it was lucky that this went on right now, and that's not going to minus out later. And so putting all these things together just make us very prone to bad statistical decision making, and then a lot of times not even realizing it or taking accountability for it. So, in closing, be careful with what you do. If you made money, I'm very happy for you. Don't get a big head about it because it was lucky. The best thing you could do is not to let it ride and keep going like you're the most awesome. It would be to adopt a prudent long-term investment strategy. Take what you have made, set yourself up for the future, and diversify, buy low, sell high, and save well, make good tax decisions, etc. If you've lost money, don't take the wrong thing from that either to say, well, investing's just rigged. I'm never going to invest again. I'm only keeping stuff in the bank. I mean, you do that for 20 or 30 years, the opportunity cost of what you lost from the compounding amount of money if you had invested is devastating. So, again, nothing here is meant to be individual investment advice. We want to point some things out to you. You should have a financial advisor or a financial planner. You should have somebody that helps you with your taxes, whether that's your financial advisor or your CPA. You should make sure that you have a good estate plan, even if you don't think you have much money, to make sure that you take care of your family and the people that you care about. Planning is important. And getting rich quick, while it can happen, it's very small probability. It's kind of like winning the lottery that you're going to get it and it's going to stay, etc. So understand how to get rich slow, to build up good habits, to save correctly, to build a good team of people that are going to work for you and be on the same side of you, on the same side of the table as you. And sometimes even like what we do for our clients is to be the person that's a fiduciary for them, to watch out for the brokers and the custodians and the exchanges, and even when the government won't do it for them, right? So we help them. So anyways, hope you guys are having a great weekend. Sorry this one was so long. It just seems like such an important subject, and there is not a lot of prudent advice out there. It's more pop information about like what's going on, understanding it, talking about people that made money or lost money, or the philosophy of what they're doing. And to me, absolutely, those are interesting. I like reading those as well too, but it is probably the least important of what is going on. So have a great weekend. Join us next week. We're going to do the future of investing, where we're going to talk about direct indexing and fractional shares, artificial intelligence, and blockchain, and some of the great things that hopefully can come from these that will help you. Then the week after that, me and AC Middleton will be interviewing Ricky Taylor from the Association of African American Financial Advisors. That's going to be a great one. And then the week after that will be our book review. Tony and I will be doing Death of the Banker by Ron Chernow. So if you are keeping along with us on that, pick that book up, read it with us, start the discussion. We're excited to have it with you. So have a super weekend.